Okay, let's look at a a ratio problem where we review several different kinds of ratios. We're going to take a look at the current ratio, the quick ratio, cash conversion cycle, accounts receivable turnover, inventory turnover, gross profit percentage, and net income percentage. So current ratio, hopefully you remember, that ratio is current assets divided by current liabilities. So let's see here. The information that we're going to need is going to be current assets, 195,000 here, divided by current liabilities, and fortunately we're given those, otherwise we would have to calculate them and add them up, and that's 1.56 times. So this particular company has $1.56 in current assets to cover every dollar in current liabilities. Let's look at the quick ratio now. So this is just quick assets divided by current liabilities. So quick assets are those that can quickly be converted into cash. Obviously cash can. Short-term investments, those are like 90-day treasury notes or savings accounts, things like that, and accounts receivable. So those three items will be our quick assets. Then we need our current liabilities, again, 125, and that gives us an even more stringent ratio of 0.96. So that means they only have 96 cents in quick assets for every dollar in current liabilities. We would prefer a 1-to-1 ratio there. Cash conversion cycle, oh, this one is a little complicated. You have to calculate first day sales and inventory, then the receivable collection period, and then we subtract the accounts payable payment period to get the cash conversion cycle. So let's go ahead and look first at day sales and inventory, and hopefully you can read my writing here. Average inventory divided by cost of goods sold divided by 365. So average inventory, we have to take our beginning plus ending here, which is 70,000 and 50,000, which I've got, and divide that by 2. That'll give you an average of 60,000. Then take your cost of goods sold, which is down here, 350,000. Divide that by 365. If we do that, we get 958.9. And take 60,000 divided by the 958.9, we get 62.57, or 63 days rounded. Okay, so remember that 63, we're going to need it. Next one we need to look at is our receivable collection period. So that is average accounts receivable divided by net credit sales divided by 365. So again, let's find our accounts receivable. We need an average there, beginning plus ending. So that's 90,000 plus 70,000 divided by 2 up here. Then we take our net sales of 600,000, divide that by 365, which gives us 1643.84. Take the 80,000 average accounts receivable divided by the 1643.84, we get 48.66, 49 days rounded. Okay, so that's 49 days. And then we have to calculate the accounts payable payment period. And again, this one starts with average accounts payable, so we'll go down here and find that. That's 45,000 plus the 40,000 divided by 2 will give us that average. Take then the cost of goods sold divided by 365. That gets you 958.9. So 42.5 divided by 958.9 gives us 44.32, or 44 days rounded. So if we take those last three calculations and we plug them in, you get 63 days, day sales and inventory, 49 days for receivable collection period, minus the accounts payable payment period of 44. The cash conversion cycle for this particular company is 68 days. Alright, we got a few more. Accounts receivable turnover ratio is your net credit sales and divided by average accounts receivable. So let's take a look here. We've got net credit sales of 600,000 and our average accounts receivable of 800,000, which is beginning plus ending divided by 2. Okay, I went ahead and wrote in the divided by and equals there for you. Alright, moving on down, we've got inventory turnover ratio. So this is cost of goods sold divided by average inventory equals our inventory turnover ratio. So again, cost of goods sold is 350 down here. Average inventory we'll have to calculate beginning plus ending divided by 2. Right there. And that gives us an inventory turnover ratio of 5.83 times. So higher number would be better. It's only turning over inventory on the shelf roughly 6 times a year, so that's less than twice every 2 months. Gross profit ratio. Here we take gross profit divided by sales gives us our gross profit percentage. Remember, to calculate gross profit, you have to take sales minus cost of goods sold. So we know our sales down here is 600,000. And then our gross profit is 350, so that means cost of goods sold is 350, so our gross profit is 250,000 divided by the net sales of 600,000. So gross profit percentage of 41.7%. With that, that means for every dollar sold, 41.7 cents is gross profit. That gross profit goes to pay all of the other expenses that a business has. So higher number is better. Net income percentage, the last one. Take your net income divided by your sales. Well, net income is given to us here of 53,000. Sales of 600,000. That means a net income percentage of 8.8%. So for every dollar sold, this particular company makes 8.8 cents. They get to put in their pocket as net income. Thank you.